Good morning everyone and welcome to another RF crypto video. Today's markets, they haven't moved that much for the crypto market. I mean 2% in the stock market would open a lot of eyes and would mean that it's a good sign. But in the crypto market, 2% is generally quite low. The global crypto market cap now stands at 911 billion. Yesterday it was below the $900 billion mark, so it's good to see it go above that. However, we still see your major cryptocurrencies like Bitcoin and Ethereum on a 7-day downtrend. For example, Bitcoin is 3.32% down in the last 7 days and Ethereum is almost 3% down. The rest of the market, they're doing relatively okay. Shiba Inu 7%, Polygon surprisingly 23%, and the other coins are in the green with some in the red, but obviously, as you know, these are due to token-specific factors that are uncorrelated with the market. As such, the market is in a positive trend, although very small, so all the markets will follow that trend. And we can see here that the Ethereum gas fees have increased quite a bit. Now it's 35 Gwei. That means that there's a lot more activity in the Ethereum network than there was in the past few days. What this could mean is that people are buying Ethereum or selling Ethereum. But seeing that the prices are quite stable, I believe that it is a tug of war between the bulls and the bear. Now, looking at the Bitcoin charts, it hasn't moved much since yesterday. It's still trading between 19,000 and 21,238. But since yesterday, it's been trading between 20,800 and 19,700. So it is now trading laterally. The market is in a consolidation phase, and the traders are seeing how the market is going to move and they want to react accordingly. A lot of people are also taking leverage positions. I will show you just now why I believe that. And this could trigger further volatility in the price of Bitcoin and in the cryptocurrency market itself due to increased risk of liquidity as the options expiry and futures expiry is due on Friday or tomorrow. But for now, it is trading laterally. We see that the trend is around 20,000. If you put a line here, you can get an average of 20,000. As I said before, I believe that a lot more leverage positions are being taken in due to the fact that when there was this massive crash, the leverage ratio dropped significantly and now it's sharply rising once again. Although it dropped it was at 0.24, now it's at 0.25 almost, and we are seeing a slight uptick in leverage. And this is mainly due to the fact that people are now gaining a bit more confidence in the stability of the price, and therefore they're more comfortable entering leverage positions. Although these leverage positions haven't gone up by a lot, it's still significant. So Bitcoin, Ether gained ground ahead of crypto options witching. The largest cryptocurrency rose as much as 3.9% before correcting, and Ether as much as 5.8% before correcting as well. And these gains have come before Friday's weekly expiry, the current quarter's last, that also coincides with the futures expires to produce the final witching in the first half of 2022, which is options and futures expiring at the same time. So options open interest indicates over $2 billion in notional for Bitcoin and $1 billion for Ether options, making this the largest on-chain expiry on the horizon by a wide margin. So there's a lot of leverage in the market, and over $3 billion just in the top two cryptocurrencies are set to expire tomorrow. And in terms of the pricing, the Bitcoin options expiring tomorrow are mostly puts for strikes around the current price levels with notional open interest concentrated around $20,000 strike. So most of the options that are expiring are puts, which are options to sell or a bet that the price of Bitcoin is going to go down. So if there's a massive increase in the price of Bitcoin between today and tomorrow, then these short traders are going to lose a lot of money, because if the price of Bitcoin moves upwards, it's moving against a short bet. And if the price goes up sufficiently or way above 20,000, which is the strike, then the short positions or the put options will be liquidated and there will be a lot of leverage flushed out of the market, which would cause a massive volatility in price. However, if the prices remain at around 20,000, there won't be much that will happen in the market, and the markets will react by not buying or not selling much, and the prices will remain stable. Also, the crypto markets are struggling to consolidate after declining precipitously in recent months as the Federal Reserve hiked interest rates to contain inflation. So the crypto market is now consolidating, I said when we were looking at the charts, in the sense that people are looking at what is the best asset to put their money in. And it's consolidating in the sense that there hasn't been much volatility in the last 2 to 3 days. However, in terms of consolidation and stable pricing, it has struggled to do this in the last months because the Federal Reserve has hiked interest rates, and when it has done that, the price of Bitcoin has suffered as a result. And not only that, but the collapse of Terra Luna ecosystem and the continued concern about hedge fund Three Arrows Capital have further rattled investors and decreased confidence in cryptocurrencies, which have caused the price to remain relatively low. And this is why the prices of cryptocurrencies, especially your Bitcoin, your Ethereum, your Solana, and your Polygon, haven't recovered much since the time when Bitcoin dropped from about $30,000 to $20,000. And turbulence has returned to the crypto space as high inflation threatens the valuations of all risky assets, including equities. And as central banks continue to reverse previously accommodative policies, we can expect more volatility in the Bitcoin price. So because there has been a lot more interest rate hikes and a decrease in the amount of assets in the Federal Reserve's balance sheet, we see that it goes against the crypto market because money becomes more expensive to borrow, and therefore people are more careful where they place their money. So they prefer placing their money in safer assets like equities and bonds instead of riskier assets like cryptocurrencies. And that's why the prices have remained depressed. So stocks slides with yields on rising recession risks. European stocks retreated and bond yields tumbled as comments by Federal Reserve Chair Jerome Powell and growth data in Europe stoked fear about a global downturn. So the Stocks Europe 600, which is equivalent to the S&P 500 in the US, dropped by about 1%. Jerome Powell, the Federal Reserve Chair, accepted that the steep rate increases could trigger a recession in the United States, and said that the task of engineering a soft economic landing is quite challenging, and policymakers are taking drastic steps to cool inflation at a 4-decade high, and the Fed chair repeated his resolve to get consumer price growth, or inflation, back down to the 2% target. Because the rate hikes are very steep and economic growth is quite low, there is always a risk of a recession. This is due to the fact that rate hikes cause the economy to slow down even more because it cools demand. It can cool down the economy so much that economic growth rate turns negative. So the Fed is also well served by keeping some hawkishness there, or some negative sentiment, because if they appear that they have reached the peak or they have reached what they can do in order to control inflation, the financial conditions will loosen and the policy won't work. So there will still be a lot more pain in the coming months or even in the coming year, because it's the fact that they need a couple of months of hawkishness. However, if the conflict in Eastern Europe is resolved within this time, I believe that we are in for a boom, because the prices of oil and commodities and food will drop so much that the demand will increase and economic growth will take off. Surprisingly, oil has also dropped to $104 a barrel because of fears over the demand outlook. There is fears that there will be a decrease in the demand for fuels which are derived from oil, due to the fact that people are now strapped for money, they're strapped for cash. Inflation is extremely high, so people can't afford to purchase as much fuel as before. And because the economic growth rate is going to slow down, that will inherently slow down the demand for oil. And because of the expectation of a slowdown in demand for oil, the price has already reacted by dropping to $104 a barrel. So something else relating to an increase in the rate hikes is that JPMorgan lays off hundreds of employees in mortgage division as rate spikes. I think that this will start becoming a trend where most banks will lay off employees in the mortgage division due to the fact that mortgage rates have risen so much, and this has rocked the housing market. This really hurts demand for new mortgages and refinancing of existing mortgages, because if interest rates increase, borrowing money to purchase houses becomes a lot more expensive. So people are less willing to buy houses at a time when interest rates are so high. Also, those with existing mortgages are less willing to refinance their existing mortgages, especially if they have a fixed interest rate, because if they do so, it will become a lot more expensive to them. So there is a lot less demand for mortgages, And there was a lot of demand for mortgages during the pandemic due to the fact that interest rates were so low. That's why JPMorgan's mortgages division was fully staffed. But now they don't need so many employees. Therefore, a lot of people are losing their jobs because of the rate hikes. And this is just one more example of the pain felt due to the interest rates hikes. And I think this will be a trend that will hit not only mortgage divisions, but banks, financial institutions, and any other institutions that deal with interest rates due to the fact that money has become more expensive. And that's it for today's video. Thank you very much for watching. If you enjoyed the video, please consider leaving a like, hitting the subscribe button, and sharing this video with your friends and family. Invest wisely, and cheers.